geopolitical tensions are once again making waves, potentially reshaping global economic narratives and investment strategies. First up, we're tracking the intriguing diplomatic dance between South Africa and the United States concerning the upcoming G20 summit. South Africa initially claimed the U.S. had a change of mind regarding a joint statement at the first G20 held on African soil, a claim swiftly denied by the White House. This disagreement centers on a U.S. warning against pushing for a joint statement. Why does this matter for your portfolio? Geopolitical friction, especially within forums like the G20, can signal broader shifts in global alliances and economic policy coordination. For investors, this creates uncertainty around international trade agreements and capital flows, particularly impacting emerging markets like South Africa. We'll need to watch closely for any further developments that could influence market sentiment and regional stability. Let's move to our second story, where geopolitical maneuvers are having a direct and tangible impact on a critical global commodity. Our second focus is on the global energy market, where new U.S. sanctions are posing a significant threat to Russian oil supplies. Reports indicate that up to 48 million barrels of Russian oil could be left stranded at sea, directly impacting global trading dynamics and forcing major buyers to reassess their sourcing strategies. The economic impact here is substantial. Such a large volume of stranded oil could lead to immediate supply disruptions, heightened volatility in crude oil prices, and increased costs across the shipping and insurance sectors. This situation forces a critical reevaluation of global energy supply chains and could provide opportunities for alternative oil producers. Investors should monitor oil futures closely, along with the performance of shipping companies and energy sector stocks, as these ripple effects unfold. From global energy shifts, we now turn our attention to a major development closer to specific equity markets. Finally, we bring you news from the Indian financial sector, where ICICI Prudential Asset Management is reportedly nearing approval for a substantial $1.1 billion initial public offering. The company submitted its draft prospectus over 4 months ago, outlining a plan for Prudential to sell a 10% stake, or approximately 17.65 million shares. This is a significant event for the Indian market and for investors looking at emerging growth opportunities. A successful IPO of this magnitude from a leading asset manager signals strong investor confidence in India's economic trajectory and its burgeoning financial services sector. It offers a direct pathway for investors to gain exposure to one of the fastest-growing wealth management markets globally. We anticipate keen investor interest, and a positive market reception could set a precedent for other large-scale public offerings in the region. Keep an eye on the final approval and pricing details, as this will be a key indicator of market sentiment towards Indian equities. In summary, we've seen how geopolitical undercurrents continue to influence global trade and energy markets, demanding vigilance from investors. Simultaneously, robust growth narratives in specific emerging markets, such as India's financial sector, continue to present compelling investment opportunities. The coming weeks will be crucial for observing how these diplomatic tensions evolve, how oil markets react to supply constraints, and how a major IPO like ICICI Prudential's performs. These developments collectively offer a nuanced picture of global financial health and potential investment pathways. Drop your thoughts in the comments, and if you enjoyed the video, give it a thumbs up. Don't forget to subscribe and hit the bell icon. Thanks for watching. See you next time. This is not financial advice.